Good afternoon, everybody, and happy 4th of July. We hope that you're celebrating independence like we have been and that you've had treasured times with your family and friends. I'm Bruce Roberts. I think most of you know that, and I'm joined by our portfolio manager, Bob Key, and our other financial advisor in our office, Jessica Kinnunen. Um, Today, we just want to spend a little time updating you on performance in the portfolios and what our thoughts are going forward. A lot of these things are themes that we've been talking about for weeks in the correspondence we send out to you. But we thought, some of you just like to see our mugshots and see us talking. And so today we wanted to spend a little time with you a little more personally. Bob, I want to start out and talk about our performance year to date, but also, now we have performance numbers for over 5 years. Tell us on an absolute and a relative performance how things are going versus our benchmarks.
The process has performed well since inception. Year to date, we're pretty close to benchmarks, but since inception, we've consistently added about 300 basis points, fancy way of saying 3%, versus what you'd get in just sort of a passive buy and hold strategy. There's been, obviously, we've been through a lot. If you think back, we've gone through everything from COVID to largest interest rate hikes in 50 years. So there's been different strategies that have worked at different times, but it starts with really our long-term strategy, where we, again, corresponded quite a bit on our reasons for systematically underweighting international capital markets in our long-term strategic portfolios versus the benchmarks. And I won't get into too many of those details here, but the other piece that we've really tactically done a nice job with is adding and taking off interest rate risk depending on basically Fed moves and where interest rates have been as they fluctuated wildly over the last couple of years.
Yeah, and just for our viewers, our most conservative portfolio, had you just went to sleep 5 years ago and put your money in it and then never looked at the media, never looked at the statements, and then woke up today, you'd been averaging 5% a year.
Mm-hmm.
And the most aggressive portfolios, the same 5 year period would have earned 8%. But I think a lot of people don't realize how well things have been going because last year was tumultuous.
I'd agree. I think there's two dynamics that go on now. There's it does, if you certainly you're hearing the constant news of doom and gloom, and don't forget during that period interest rates were 0%, which means you're earning 0% cash or 0% not being invested. The other dynamic that goes on, Bruce, is when markets rally and then sell off, and they fluctuate up and down, people tend to look at that high watermark as being their reference point, not their original point at which they invested. When you look at where someone invested 5 years ago versus where they are now, they're really right in line with what we would hope someone's long-term average return would be. Obviously, we peaked at the beginning of 2022 before the Fed started to really aggressively tighten monetary policy. So although they might be slightly lower than the peak rate, the long-term rate is still very much where we would expect them to be given historical averages.
Thanks, Bob. And I know that you mentioned our position on international. And so I'm kind of curious, we added some international, we got rid of some international. Where are you thinking we're going in the future here as a?
Yeah, we've been very active, and we added European equity in particular, I'm guessing 6 or 9 months ago. And fortunately, it's rallied and done very, very well. Things were so doom and gloom in Europe, given various things, but the Russia-Ukraine war was a big piece of it, that we were going to have this dark winter with no energy. And Europe actually survived that fairly well. A lot of people say it's because of the mild weather. I think it's more than that. They've been able to contain the war, etc. So valuation, anyways, on Europe just got extremely cheap. Everybody expecting it to be just a really dire situation over there. It wasn't nearly as bad. So it wasn't so much that we were constructive on the European economies. It was that stocks had become so cheap over there that relative to what was actually going on in the economy, they were still a good purchase, even though we weren't overly excited about the economy. those stocks have actually rallied quite a bit and gotten back up to fair value. And as they start to approach fair value, I think there's a good chance we're going to start decreasing that European exposure again. Europe, unlike the U.S., which we've been, our contrarian views coming around the U.S. with this view, more and more people are jumping on. There's not going to be a recession story. Europe is almost certainly in a recession. If not in a recession now, they're almost certainly going into a recession. So we'll probably start paring back our European positions that we have over there pretty soon.
Bob, I want to change gears a little bit. There's been an awful lot of talk about the Supreme Court ruling going against the Biden administration's wishes to forgive student debt. And we've written a little bit about this, but we're still getting some questions regarding, is this going to tank the economy because folks are going to have to start paying on their student debt? Can you put it in some perspective for us?
Yeah, my perspective, I mean, just mathematically it's a completely insignificant amount of and the overall GDP of this nation, it's insignificant, right? And most student debt is also held by the younger crowd, which our economy is driven by 34 to 56-year-olds. That's how this world works. That's where spending comes from. So I know it's a hot political issue. Try not to go down that path. I do think it creates a certain moral hazard if you're not repaying loans in general. I think that's what loans are, whether student loans or car loans or house loans. Loans are meant to be repaid. It maybe, puts systemic issues into our financial system when we say you don't have to repay loans. But as far as the actual economic impact, it's a completely insignificant economic impact because the actual value of the student loans outstanding is completely insignificant relative to mortgages and everything else. And the people that are repaying them are already very low contributors to the GDP of the economy.
So speaking on loans, interest rates, things like that, what are our forecasts? There's been a lot of concern about interest rates and them increasing even more. What is the forecast, looking forward here in the next 12, 18 months?
So our view again has been, we've been way below the consensus view on where inflation's going. And inflation fortunately has been falling, continues to fall, which ultimately means that interest rates are going to fall. The counterpoint to that is that we have a Federal Reserve that, although they paused last time from rate hikes, are talking about raising rates at least twice more now, et cetera. So it's hard, at least for the short end of the yield curve, to come down when the Federal Reserve keeps raising rates, which is, it's the Fed fund rate, which impacts the short end much more than the long end. So, at least the first, 5 years of the yield curve, we're going to see remain elevated, I think, until the Fed officially is done pausing rates. It's called, the yield curve is called more inverted, meaning that longer term rates, although they've gone up a little bit, haven't gone up nearly as much as shorter term rates. And that reflects the fact that longer term inflation expectations are still lower. I think the longer end of the curve is at the higher end of their range. And the shorter end will almost certainly start to come down too. Again, we're all somewhat, it's going to depend on what the Fed does, which right now it looks like they're doing 50 more basis points, 2 moves of 25 basis points, but rates should generally start moving down after that. The systemic reasons that inflation, the deflationary, I call it, factors that are in the economy are still there. I think inflation will continue to drop, probably start to sneak up to close to about 3% year over year by the end of 2023, which should bring overall rates down.
Bob, we really appreciate your knowledge and taking the time out to visit with our clients directly today. For those of you who really like Bob, he's going to be coming to the Midwest live. We're going to be hosting events both in Wisconsin and in the Marquette area in late September. And of course, we'll continue to be sending things out every couple of weeks, letting you know what we're doing so that you don't need to call us. We'll call you. But most importantly, you've delegated your worries to us. We want you to know we're paying attention. We really appreciate you and thank you for your business. And we'll see you again really soon. Thanks again.
Thank you, everyone.
Thank you.